How a fax almost broke the financial market in 2010. Imagine this. In the 21st century, with high-frequency algorithms dominating Wall Street, a simple message sent via fax, yes, a fax, almost brought the global financial market to its knees. Sounds like the plot of a wild spy movie? Well, know that this story is real, recent, and exposed the vulnerabilities of a billion-dollar system that many believe is infallible. How did something so outdated manage to challenge the pillars of the U.S. stock market? What was written in that fax that triggered automatic orders, caused the domino effect of panic, and wiped out $1 trillion in minutes? In this video, we'll travel back to May 2010 when an event known as the Flash Crash revealed how the modern financial system can be as vulnerable as a typewriter in the middle of a technological race. Get ready to understand how human decisions, technical failures, and the simple transmission of information were enough to cause one of the biggest scares in Wall Street's recent history. But pay attention, the real cause may be even more surprising, and it makes us rethink who truly controls money in the world. May 6, 2010 seemed like just another ordinary day in the financial markets. Trading had opened normally, indices were fluctuating slightly, and investors were analyzing the day's news with almost robotic routine. But around 2:32 p.m., something inexplicable began to happen. The Dow Jones Index, which includes the largest companies on the American Stock Exchange, plummeted abruptly, losing nearly 1,000 points in less than 10 minutes. To those watching in real time, it seemed like the start of a new financial collapse. Within minutes, shares of giants like Procter & Gamble, Accenture, and General Electric dropped to absurdly low prices. Some were traded for mere cents. Logic vanished. Investment funds froze. Trading robots went into emergency mode. And at the center of the storm was a technology no one expected to see involved in an event of this magnitude: a fax. But before we explain the role of that fax, it's important to understand the environment that had been carefully set up over the previous years. Since the early 2000s, the stock market had undergone a silent but powerful transformation: the rise of algorithmic trading. Instead of traders shouting orders on the trading floor, the new Wall Street became dominated by robots programmed to buy and sell stocks in fractions of a second, based on patterns, probabilities, and even keywords in news. These algorithms operate at extreme speeds and largely without human intervention. But this efficiency comes at a cost. Any unexpected noise can be interpreted as a signal of panic and trigger mass sell orders. And that's exactly what happened that day. Amidst the chaos, analysts began to seek explanations. Could it have been a typographical error, a fat finger, where a trader might have sold billions instead of millions, or a failure in the systems of some brokerage? Rumors took over the news, but no theory seemed to explain how rapid and profound the drop had been. Then, among documents analyzed by the SEC, the U.S. Securities and Exchange Commission, an intriguing piece of data emerged. A large automated transaction of futures contracts was initiated almost simultaneously with the sharp decline. And this operation had been authorized from a fax. The story began to take on even more bizarre contours. One of the world's largest hedge funds had sent a fax authorization to execute a massive sale of S&P 500 index contracts, without volume limitation, without pause, and without considering the market impact. The algorithmic system responsible for the orders followed the command, sent on paper to the letter, without any filter or common sense. The transaction, though technically correct, acted as a spark in a powder keg. The robots of other brokerages identified an abrupt movement and began to sell desperately. The chain of algorithms was activated. Human investors were paralyzed, and prices plummeted. It was a portrait of an extremely modern system, still dependent on outdated processes. A fax, which seemed harmless, had become the trigger for a flash crisis. And yet, the worst was yet to come. Because the consequences of this mini crash did not end with the close of trading. In the minutes that followed the collapse, the scene at the New York Stock Exchange seemed like a financial disaster movie. Red screens, confused operators, orders being rejected or executed at absurd prices. Solid companies with a history of stable profits and healthy balance sheets had seen their stocks plummet by more than 90% in a matter of seconds, only to recover shortly afterward. It was as if the market had suffered a mental blackout, and no one could quite explain what had happened. The event became known as the flash crash, a lightning-fast collapse that lasted only 36 minutes, but temporarily wiped out about $1 trillion in market value. Yes, 1 trillion, more than the GDP of many countries, evaporated amid a sequence of automatic clicks and cold decisions made by software that doesn't feel fear, but also lacks discernment. The psychological impact was immediate. Institutional investors began to doubt the robustness of the system. Small investors, who watched in bewilderment as their portfolios plummeted and rebounded like a yo-yo in less than an hour, questioned whether there was still any logic or security in trusting the markets. For the first time since the 2008 crisis, the specter of structural distrust once again loomed over Wall Street. And that's when the role of the fax machine took center stage in the plot. The investigation revealed that the order to sell S&P 500 futures contracts worth $4.1 billion was sent by a firm called Waddell Reed, which used an internal system without the brakes that would limit the speed or volume of the operation. This sale was initiated from a fax authorization, and the algorithm that executed the order did not stop until the total volume was completed, even if it crashed the market. The blind execution of the sale created a negative spiral. Algorithms from other brokerages identified a panic pattern and began dumping assets as well, trying to get out before the supposed storm. The problem? There was no real storm. No bank was breaking, no war had started, no bad economic data had been released. It was just the system reacting to itself, an echo that amplified within a mirrored hall. The event also sounded a red alert about the opacity of high-frequency trading algorithms, which represent a gigantic portion of the volume traded on modern exchanges. Who controls them? How are they programmed? And more importantly, who stops them when everything goes wrong? After the flash crash, the SEC and the CFTC, the U.S. regulatory agencies, intensified their investigations and promised reforms. Mechanisms like the limit down emerged, which halts trading when there are abrupt drops, giving humans time to regain control. But many critics warned, these solutions are merely stopgaps. The real problem lay in the growing dependence on automated decisions without adequate human oversight. And the facts? It became a symbol of irony. In the midst of the era of ultra-sophisticated algorithms, a technology from the 1980s still had the power to trigger a billion-dollar collapse. This combination of obsolete infrastructure with modern operations revealed the fragility of the global financial system, like a state-of-the-art airplane with its manual still printed on a mimeograph. The question that lingered in the air was, if a simple fax almost broke the market, what else could happen without anyone noticing in time? The 2010 flash crash was more than a technical glitch. It was a warning, an urgent call for us to reflect on the invisible world where billions of dollars change hands in milliseconds, often without any direct human involvement. The most curious thing about this story is the paradox it exposes. While technology advances by leaps and bounds, with artificial intelligence and algorithms controlling complex financial decisions, archaic systems like the fax, a device that many no longer even know how to use, can still be at the heart of the most critical decisions. And this reveals an uncomfortable truth. Modernity does not always mean security. The episode reminds us that the global financial market is becoming increasingly interconnected, automated, and vulnerable. A single command, a logical error, or a parameterization mistake can trigger a chain reaction capable of shaking the value of companies, pensions, investments, and even national economies. But don't be fooled. The greatest risk may not lie solely in the codes or the machines, but rather in the lack of human oversight and the blind belief that automated systems are infallible. With each new flash crisis, it becomes clearer that confidence in the markets depends not only on technology, but also on responsibility, transparency, and common sense. And you? Have you ever stopped to think about how invisible decisions are shaping the value of the money in your pocket? How many orders are being executed at this very moment by robots that no one monitors in real time? How many near catastrophes have already happened and haven't come to light simply because the system managed to correct itself in time? The 2010 FAX case is one of those stories that seems absurd until we realize how real and recurrent it can be. Technology is fascinating, but it's not neutral. It carries human interests, limitations, and flaws. And when we let it operate without supervision, the results can be devastating. That's why stories like this need to be told, because understanding the past, even if it's recent, helps us avoid repeating the same mistakes, especially when they're hidden behind screens, servers, and lines of code. If this story surprised you as much as it surprised us, leave your comment below. We want to know your opinion. Do you trust the algorithms that control the financial system? Do you think humans should intervene more? Have you experienced something similar in the world of investments? And if you enjoyed the content, subscribe to the Mundo Enriquecedor channel, turn on notifications, and dive with us into other stories that reveal the curious, frightening, and fascinating behind the scenes of money throughout history. Here, you understand what's behind what moves the world.